What's up, Joe Doing it? It's me again. So today is Tuesday, June 17th. So I took a couple days off for Father's Day, and I'm sure you guys were overwhelmed with everything. You had to get your midterm done and taking a sigh, okay? Pat yourself on the back for progressing, okay? So well, all right. So we are in the fourth week of this class, and again, this is, it's a lot to keep up with. This is the third module this week, and it's going to be from module 11, retirement planning. Okay, you can see right there. I got one of my Father's Day gifts on. Isn't that cool? Let's see. Okay, they pay the bills. Um, Speaking of paying the bills, so we're going to do retirement planning today. So we've really been kind of building the house. Okay, it's a saying where you're educating you about the background and we've seen the kind of world economic crisis and how too many countries have put themselves into serious debt by not projecting how many more people live a lot longer. So when you have these guaranteed income streams, these are called pensions. We don't have so much here, but other countries do. Then how are you going to pay for those? Okay. Now, certainly, as we said, the Nordic countries figured this out a long time ago. And the way you pay for it is you tax at a higher rate. Okay. We're a capitalistic society, okay, and it's up to us, as individuals to prepare for retirement. It's up to us as individuals to invest our money so that we can use the power of investment, the return on the investment, the gain, then to become a lot wealthier and be able to do a lot more nicer things and have a kind of a guaranteed lifestyle. So that's kind of what it's all about. Okay, so we've been doing the shock and awe of the big cost for average Joe. Excuse me. And that being, healthcare costs are huge. We have housing costs. Okay, we didn't get into that, but when you don't have a very large amount of income stream, and you look at housing, it's crazy how much it costs, to rent a place here in LA, much less purchase a place. And we went into that, can you afford the median household purchase price of, 900 grand a year, which is, a condo in here in Southern California? Can you afford rent? That's, 2 to 5 grand a month, These are big deals. You know what I'm gonna do? I'm gonna get a glass of water. Cheers. Okay, so so we set the stage and we showed in the week 10, okay, when we are looking at how we are set up, how poorly set up the general population here is America. Yes, there are the one percenters like myself, like many of you, and you should do fine, but there's no guarantees. But then there are so many people with such little choice, and they are inching by. Some of them do not have any income stream, but their ticker keeps going. They keep living, okay, and so this contributes to the unhoused homeless population and I just looked at this morning, the US Senate is looking to cut Medicaid even further. The real problem with doing all this is when you make big cuts to health insurance, people still show up at the hospital, so now they come in and they have no coverage. Before, the government would pay for whatever services they might get in the emergency room or hospitalization, etc. Okay. Now, if we cut it and they have nothing, compassionate society hospitals are still going to take care of them. Okay, and the only way the hospitals can survive financially, okay, the bottom line is they have to then raise the prices on everybody else. So that's what's going to happen. All right. That's, it is what it is. The hospitals don't turn people away. Your insurance premiums are going to go up. Your co-pays are going to go up, and that's, nobody thinks about these things, but that's the reality. Okay. Awesome. So let's get into some financial planning here, right? So I can tell I was just checking it out to make sure that I was verbose in this. Okay, retirement planning. Okay, um, and we got to determine retirement income goals. Do I want to maintain this lifestyle? Okay, in order to do that, to talk about this, you have to do some budget analysis. Okay, and it's no time like the present, guys, to sit down and consider. Does the money coming in equal the money going out, and how you can change your spending habits to make sure you can put some money elsewhere and let it grow. I mean, God, we're going to talk about different, some people invest directly in real estate. Some people do real estate investments through brokerages, or you do stocks like I do through large bundles, thousands of companies in a category called a mutual fund. And I get, 8% return on what I put in every year. And that compounds, we'll see later on. So I make, over 20, 30 years, I make some buck doing that, and you have to think about that. Okay. And think about maybe I should have one less cup of Starbucks and put that into a retirement account. All right. So, anyways, okay. So that's the advice here. Okay. So we're going to go over some of the basics. We've gone over Social Security. We're going to do it again so you truly understand what kind of Social Security income you can expect. This is assuming that there are no changes made to the payout. Okay. We'll talk about our investment strategies. Okay. So these are 401ks, okay, that large companies make, 403b plans. There's like supposed not for profit organizations, like USC, a not for profit organization. Ours is a 403b. Okay. They follow the same exact guidelines. There's also a Roth SEPA for small businesses that is basically the same guidelines. We're not going to get into that. And then we have what you have, individual plans. You can do IRAs, Roth IRAs, okay? We're going to talk about pensions. We're going to talk about annuities, okay? Who gets a pension? Government workers get pensions, and some of the big corporations will still give out small pensions in addition to providing opportunity to do, for example, 401k. Most private companies have eliminated pensions, okay, because again, people live too long, and the company was then hamstrung by having this guaranteed payout. All right. Rather than that, they want you to take your money, you invest it your way, it's on you. All right. All right, and that's what we're going to be talking about with the IRAs and the 401k plans. Okay. All righty. All right, so where are we? So let's again look at the kind of the reality we live. You're an individual. You're going to make a lot of money, but we have this big world, this big society in our country, and it creates, it's called socio-economic. What is that? Break it down. The economics and the imbalances that exist in different segments of society. And the unrest that happens is always socioeconomic. Okay, it's because of the inequities. It's because of the difficulties that people have to survive financially. Okay, and it can have lots of different trajectories. And I'm not going to get into all the politics, but that's kind of a core principle. Okay, and so this discussion is, what do you think we could or should do about this enormous gap between retirement needs and actual retirement savings that live, and again, about the continuum of the world where people have nothing. And of course, there are the Musks, and the Bill Gates, that it's not an issue, okay? But that's such a small percentage, okay? What can we do to promote more retirement savings, make it easier, okay? And then I want you to think about the different generations and who's better set up, okay? All righty. So, we grab reports. Okay, this is published 2019. Okay, again looking backwards at data, and it's kind of shock and awe. Okay, about um, the how well off families are. All right, so it says most families, even those approaching retirement, have little or no retirement savings. Again, this is looking at median. It's really, I love looking at the middle of the road versus the average, because again, Jeff Bezos, Bill Gates, all those kind of people, they skew the average because they make so much money. There's a big segment of society. Let's just stack everybody up and look at the very middle. That's the median, okay? And we can see here, okay, looking by age group, no big surprise, okay? The median retirement account savings for somebody that's younger, just out of college, just getting their act together, is pretty small, okay? And this is continuous across the board. And then we can look across age groups. And interesting enough, the 56 to 61-year-olds here, they, of course, are doing well. They were most impacted by a socio-economic crisis, right? 2008, all right? This was the collapse, the recession of the economy due to the run-up in housing, and then the banking system providing loans that were not appropriate, high interest loans that nobody could pay on, and so people defaulted on the loans, and then we had the collapse. Okay, but irrespective of that, even here, this is median. This is not a large amount of money, right? That's what we want you guys to look at. Okay, there is a disparity, socioeconomics, based on who you are, and we see here the percentage of people that have any type of retirement savings account. May not be much, maybe a lot. We'll just say, do you have anything? And we see, of course, white, non-Hispanic. We across the board over the period of time that this was looked at, have a much greater likelihood to be able to, budget and put money away and invest it for the future. Okay, and we can see here that Hispanic and Black populations are are much lower, maybe a third of what we got going on. 2/3 of what we going on. Who invests money? You can figure that out. Okay, college educated people like you learn about investment. College education, like people like you, get better jobs, and with better jobs, you can also peel away part of your income and not use it now and invest it for future use. Okay, so this is all, here is no high school diploma. Okay, and this is college educated and everything in between. All right, so. If these are different reports, I really like this one. So if again, this is a resource for you guys. This whole class is, I would check this out. This is, I'm sure if you know Steve Ballmer. He's the former CEO of Microsoft, the owner of the Los Angeles Clippers, and he's a good guy. He's a wealthy guy, but he does a lot of work that helps out people that are of disadvantaged communities. So he provided this resource, and it's gathered data more recently. And again, this is 2023. Nearly half American households have no retirement savings. Now, when he says that, he's bundling, of course, all the age groups. Okay, but what's really cool is he's provided some really cool graphics. Okay, and we can look at it in terms of years. Okay, so we're looking right here, 0. All right, what percent of U.S. households have zero savings? Okay, then we go in 1,000, 10,000. What do we see? We see it decreasing. So it's pretty dramatic. Just such a small percent of American households have 500,000 saved. Okay, now does that seem like a lot? Maybe it does to you. That's nothing. That is nothing. Okay. I should have about 6 times my income right now saved. Okay, so we are at my age way past this, and you see how few people have that. Okay, and then he looks at this at different types of accounts. Okay, just checking, savings. It's a good idea to have a certain amount of emergency money if you're a high income earner in your checking and savings. Okay. These are my financial assets, my retirement savings, and this is my net worth that can also include my housing. And again, we're going by age. Okay, and we see how it just and it's scary. Okay, look at how little money people have in here, so yeah, it's a really cool report. You can go further and further into this. I encourage you to do so, right? In your discussion, which again is going about what do we got to do? And here's more um, materials. Because you guys are I do recognize we have a lot of Marshall majors in this class, real estate development majors, all under the same umbrella of Marshall. And so you're supposed to be the expert on this. So this is what this discussion is all about. Okay, awesome. All right, so now we're going to get into how to become a financial planner. And a lot of you, this is going to be your first job right out of the blocks. Okay, sometimes you will actually become the CEO of a big fund managing company. Okay, there's CEO of Fidelity, CEO of Vanguard, all these different, whatever it is, Morgan Stanley, on and on and on, Chase Investments. So these are just some examples. And then there are, smaller groups. Okay. And we're going to give you the basics of what you need to know when you start at the bottom. Oh, and also you have to understand, and I say this straight up, is it's great to have somebody else do this for you, but it's really not that hard to learn how to do it on your own. And the key element is you control your money. There's no the reason people become financial planners, okay, money managers, is they need to make money. That's why they do what they do. Okay, they have to have an income stream, and part of the income stream is to buy and sell your investments. Every time they buy and every time they sell, buy and sell, they get a percentage. Okay, and then just for the use of their services, they charge fees. Okay, so all really does build up. And so I look at the time that you guys have spent. I'm blown away at how good people are at Instagram and TikTok and all these different social media venues. And if you were to get in and open your own Fidelity account, you would see that you can do this. You don't need somebody else to do it. And because there is case after case after case, whether it was Prince, Kareem Abdul-Jabbar, God, who else? Many, many people of notoriety. Shohei, okay? Let somebody else manage their money, and you just don't take your eyes off of your money, and assuming they can trust these people, and people swindle them, okay, embezzle them, and screw them out of millions, billions of dollars. All right, you can do this. Okay, so I'm going to give you the basics on this. Okay, all righty. So that's what this is all about. All right, so this right here is a really useful starting point for you. I'm not going to get into it here. Okay, I'll just open it. All right. And so this is an article put out by CNBC, okay? And it's the Ultimate Retirement Planning Guide 2022. So it gives you the basics. What's really important is they do things like this, okay? We all need to kind of live by a budget. I'll never forget during the recession of 2008, there was this giant billboard as I was driving over to UCLA for a meeting. And you know what it said? It said, act your wage. There it is. Okay. I want to do this and I want to be like that person, but you just look at your income and you be realistic. Okay. And that's what a key aspect of budgeting is all about. So you just sit down and say, this is how much I pay for gasoline. If you have a gas powered car, my utilities, my rent or my mortgage, restaurants, on and on. And you come up with a budget, and then you can look and say, maybe I'm spending too much money here, too much on entertainment. I mean, if you think about it, the amount of money that's spent to go to Starbucks on a daily basis by people is mind blowing. Okay, you can cut this kind of stuff out and then invest it. So that's what this is all about. And then they give you some investment strategies. Okay, so like I said, this is the wheelhouse of all USC business majors. You need to know this stuff. Okay, for whatever future job you have, okay? But it's also super important for all of us, okay? So we're going to talk about all the different various investment options. It's something that, when you guys are graduating, you should ask the question, do you have a 401k plan or a 403b plan? All right. Do you have a SEPA IRA? Are there matching funds? Super important to know. I'll tell you straight up with USC. So I have a guaranteed income of 9 months, and then the next 3 months that I have was based on bringing in research grants and being paid by the government for those 3 years. Okay. We can also get teaching overload when you're older and you just teach more classes like this. Okay. But that 9 month is my what my retirement account is determined from, and so I take out 5% of that in my 9 months of salary, and then USC for most of my career has matched that 2 to 1. That's just free money. So find out if the company you're interviewing for has matching 401ks. Okay, all right. So we're going to stress again the importance of starting early. Right now, well, my charge to you guys is open up an account. If you're not working, you can still open up a Fidelity account, a brokerage account. If your parents give you a gift of $1,000 or whatever it is, $10,000, you can put it in there, some of it in there, and start to play with it. Okay, you can look at the different bundles. You can look, you're young, so you can look. It's like a video game. You can determine, hey, I want to go into these companies that are new but with lots of potential, so lots of risk. Okay, or I'm going to go more stable in my investments. Okay, the core large companies called the S&P 500. Okay, so you can do that. Okay, and certainly we are always changing our risk in our investments based on how old we are. When I was 30 or 40, I could assume a huge risk and try and get a big return. As you get older, you can't afford to take a hit. There's always, what does risk mean? Okay, it means there's huge gains, but you could be hugely impacted by a problem. Okay. Alrighty, so that's what we do. Okay, alrighty. So so this is and this whole section is complemented by your next paper, okay, which is the critical thinking assignment number 2, which is cool. So what you're going to do is you're going to pretend like you're investing money into either a 401k because that's the company has that, or you're going to do it on your own into individual retirement. It's called IRAs. Okay. And there's other aspects that we'll talk about later. And then and the cool thing, these are the AARP, okay, American Association for Retired Persons calculator. So into the calculator has already set up the limits, because the limits we'll see later on are a little bit complicated. Okay, it's all set up so you just invest. You can put your income, your investing, all you want, and you're going to see what happens if you do it right. How much money you will make by the time you say 65. Okay, so it's really, really cool assignment. Okay, you just like the other one, you put in your own data and you'll get charts from it. All right. All right. So again, these are shock and awe systems. So it all depends. These graphics does not change much, okay? And so that's what this is all about, right? So in this particular publication, GoBankingRates.com 2016 report, they did a pretty cool analysis. They looked about 5,000 people, and they found that more than half had less than $10,000 saved, okay? And when you look at that, of course, again, it's age dependent, okay, as well, okay. But you see right here that the distribution of Americans that have this type of income, this type of income, you see that the higher level income, there's a lot of retirement saved because of being older, and you have lots of different assets. But you can see that the graphics are impressive. We see down here, as you might predict, women do far worse than men and have no retirement savings. So almost 40% versus 30% men have less than 10 grand. 25 women, 22 men. Why is that? Okay. Women have earn less for the same degree, same training, same everything. Okay, that's just a fact. Okay, so that means they can put in less. Women tend to have more interruptions in terms of their work experience because they bear the brunt of the responsibility of having children, right? So very, very real. Okay. And this again looks across generations. Okay. And it's looking at how much money is saved. Okay. And, and going across the board. Okay. Millennials, Gen Xers, seniors, and boomers. Up here would be your Gen Zers. Again, this thing was done in 2016. Okay. And you can see, that, sadly, 28% of people my age have zero, um, so we're approaching 50% right here, less than 10. The statistics would really vary. um, but believe me, $300,000, that is nothing. And it's a very small number that have even that. Okay. All righty. So, that's kind of a little background. All right, we'll give you a little background in terms of Social Security, and then we're going to talk about what our goal is here in this assignment right here. This assignment. So we're going to give you some goals here. So some basics in Social Security. Okay. Alrighty. So Social Security benefits. Okay. You can access this from 62, and then at 70, it's maxed out. Okay. These benefits are earned by paying into the Social Security system by working. Okay. Um, Retirees must have worked at least 10 years. Okay. And this 10-year market is an estimate. Okay. And you can also access this if you're a spouse but haven't worked. Okay, so you can access your spouse's benefits if they, for example, pass away. Okay, alrighty. The 10-year mark is an estimate with 4 quarters per year, but actually what you do is you earn credits. Okay, and the credit you can earn, say, 4 credits a year. Okay, and it's really based on how much income you have. All right, so you're not going to get the full year credit if you're not making very much money. That's this right here. Okay, you must have earned at least in 2025 this amount of money to get the full year credit going towards your 30 years. Okay, credit that makes you eligible for Social Security. So you can see here that you have to and it can be interrupted, but you have to have this total work life, or else you're out. And you think about how many people then, we look at the median Social Security income, how many people have zero? Okay, all righty. So down below, we're going to look at this figure, okay, and it shows how the benefits are progressive, and they're calculated based on your annual income. Okay, people that are lower wage earners are going to get a higher percentage than people like me. Okay, the Social Security calculation is indexed by my income. Okay, so there's a calculation based on how much I have made in my 30 years of contributing. Okay, and what they do is they average over 35 years. So that was a misnomer. 30 to qualify, 35 years for this. So if you had a number of years that are zero, then you're going to be indexed lower. Okay. All right, and again, lower income earners are going to get a higher percentage, but the net value is going to be much greater for me, okay, because I'm a higher income earner, okay. So we're looking at the figure below here. There it is, okay. So this was in 2020, the max, okay. And we can see what I'm talking about. So on a percentile basis, these low income earners, so these are people, they're retiring, they've paid in to the system, okay, for 30 years, and they're going to get this much money, okay. They're going to get $12,825 a year in 2021. See, it's gone up. It always likely goes up for adjustments in the cost of living. And so it's a closer percentage. See, this is a much lower percentage. It's more money, but I'm a higher income earner, so it's indexed to give me more money, but accounting for helping out people that are poorer. Okay, awesome. Okay. So that's kind of what we're talking about right here. Okay, so you can see in the figure below. So 142,800 on average over a 35-year period means that I'm going to get a lower percentage. Okay, so in that case down there it was about $43,000 a year at full retirement age at 67. Okay. Um, Okay, and then indexing creates a fair compensation of the distribution of Social Security income. Okay, so I'm going to get a lower percentage. That's what indexing is all about. Okay, I'm still going to get more, but the indexing system says, let's make sure, even though you've contributed a ton more than somebody who's a low wage earner, you're going to get a lower percentage. All right. Okay. So this was the average benefit in 2022 was 1,657 per month, or about a little under 20 grand a year. Okay, in 2025 the average benefit is $23,000 a year, a little under 2 grand a month. So this is way, way, way below poverty level if this is all you got, as you can see. Okay, and you have to have qualified. We're not even looking at the zero earners. Okay. All right, so the maximum Social Security benefit in 225, if I retire at 67 years of age, which is kind of the apex. If you retire earlier, you get lower percentage. You retire later, you're going to get a much higher percentage. Okay. Okay, so it's and you'll see that in a second. So it's about 4 grand a month, comes out to about 48 grand a year. Okay, if I retire at 67.77. Okay, I'm 69. I'm planning on delaying my retirement benefit because I am still making income. It's prorated for every extra month past 67.77 years of age. I get a slightly higher percentage. Okay, if I take it out to 70, then that's it. I've maxed out. So what I'm going to do, instead of getting the 4 grand a month, I'm going to get 5 grand a month. So instead of having $48,000 per year, I'm going to have $61,000 per year if I do delay it by 70. So there's an incentive to keep working, if you make good money, and then delay the Social Security income that you're going to take till 70. Then maybe I'll still be working. Okay, I will work and get my Social Security. It will raise it adds to my taxable income. Okay, it's all good. All right. All right, so that's the way that works. All right. So this assignment. So we've educated you about Social Security. We'll do it again because people can't wrap their heads around it. Okay. We're going to talk about, again, Social Security benefits versus age retirement, something I hinted at right now. Okay. We're going to talk about a tax deferred. What does that mean? Okay. That means every year I have to pay income tax. Okay. And the percentage of income tax that I pay goes up and up and up. Based on how much money I make. It's tiered. If I make enough money, I'll go into a new tax bracket and go from maybe paying 25% of my income in federal income tax to maybe paying 32% of my federal income. All right. So one way to keep that from happening is to take out money and put it into my 401k. Okay. So it's subtracted from my paycheck. Now the feds, when they look at my taxable income, it's reduced. And so I defer this, and I'm going to pay taxes of that money I put into my 401k later when I start taking out when I'm 72 years of age, when I'm retired. Okay. And the concept on that is my expenses are much greater right now. And I'm making a lot more money, of course, right now. So I'm paying a higher tax rate right now. So anything I can do to reduce my taxes is great. In all likelihood, when I'm 72, okay, I will no longer having to deal with a multi-gen household, okay? So I'm not going to be paying for tuition and different features of my kids' life to give them a head start. So less money is going to be going out. In reality, am I going to be traveling as much as I used to? Probably not, So when I start withdrawing from my my Fidelity account, my 401k, you only get taxed based on whatever you pull out and use. So every year, if I use 200 grand a year, I will only get taxed on 200 grand a year. Okay, if I only pull out 100, I only get taxed on 100 grand a year. All right, so I'm really reducing the rate. So instead of being, like I said, 25 or 32%, maybe I'm at the 15% taxable income rate. So that's the attraction of doing this. Okay, along with the fact that all the gains I'm making. So, I'm compounding. So I put in 100 grand, and before you know it, that 100 grand is worth $1 million. Okay. So those gains just accumulate. I don't get taxed on them if they're in a 401k plan. Okay. If you have your own investment strategy elsewhere called a brokerage account, then you pay capital gains tax. But I'm not paying for the gains right now. And then, okay, so I die, all right? All those gains, all the money that I have earned in my investment accounts, then that gets passed along to my kids. And again, minimal tax then, right? Okay, awesome. Which is a benefit for the family. All right. All right. So that's key. All right. So we're going to be talking about this. We're going to talk about our IRAs and Roth IRAs. Okay. These are opportunities that you do outside of your company. You do this as an individual. Okay. There are different limits on that. Annuities, which are investments that you give money to an insurance company, and then they guarantee a stream of income. So if people are risk averse and they just want to know their whole lives are going to have this guaranteed stream of income, then that's what annuities are about. Buyer beware, okay? Because they take your money that could be making 10% a year, and then they'll guarantee maybe you making 5% a year. So there's only one reason why these you get such hard sales pitches from investing companies to buy annuities is because they're going to be making money. Okay, even fine print. Something old days, people would invest in an annuity, they would die, and then the insurance company would take the entire principal, and then the beneficiaries, your kids, would be like, "What?" Okay, that is more rare now, but still, it's still out there. So you got to be careful. You always got to read the fine print. Okay, so my challenge to you guys is right now, with your parents' help, or if you're on your own, go ahead and open up online a Vanguard, a Fidelity, whatever your favorite investment company is. Open it up right now and get to know it. It's like a video game. It's freaking awesome. Okay. And then what's really cool about it is when you start putting money in there, then you can start checking it. And it's really neat to watch it just grow. You put money in there. You haven't done anything other than invest it into a category of corporations. Okay. That's called an index or a mutual fund. And all of a sudden, poof, it's taken off. In a year, that $1,000 you put in, is now worth, 1,200, whatever it is, maybe it's worth even more. Okay. And then every year, it takes off. Okay. You'll see that when you do your CT2. Okay. All right. So again, the basics about Social Security. All right. So remember, your paycheck, we have 12.4% taken out for Social Security tax. Half for you, half by your employer. If you are self-employed, then you got to do the whole full 12.4%. Okay, which kind of sucks. All right. Big problem with this Social Security tax, okay, in terms of keeping the system going, is that it maxes out. Okay. So this applies only to your income at 176,100. After that, anything I earn beyond that does not have Social Security tax applied to it. All right. So maybe we should prorate that. Maybe to keep the system going, to make it so other people make more money when I'm making so much money. Okay. I don't know. So are we a compassionate society? All right. All right. All right. This limit is called the wage-based limit, as we see right here. Okay. All right. Medicare insurance tax does not have this wage-based limit. All right. So the payroll tax, this is the Medicare tax, 2.9%, applies to the entire amount that I earn. Okay. And then if I make more money, so they're doing what exactly I'm saying. They get a little bump in tax based on my income, and it helps keep the system alive. Okay. All right. So this is something that's always on the table. Can we just put more money into the system? Can we be a little bit more like Sweden or Norway? Okay. All righty. So again, this is the maximum Social Security benefit at the full retirement age of 67.77 years is this much a month. Okay. Alrighty, and this comes out to about, again, 48 grand a year at this retirement age of 67. Okay. Alrighty. And this applies, right now. You look at those who turn 62 in 2025. This amount applies to you. Now, if you retire at age 62, you are going to get 30% less. Okay, there's a disincentive because the government doesn't want you to be drawing from Social Security for that additional 5 years. You should be out there working. Okay. All right, so that's what that's all about. Okay, there is also an incentive, okay, to go beyond 67 years of age. Okay, so for every month that I'm beyond 66.7 years of age, I get a little bump in what my Social Security benefit would be. Okay, and at age 70, okay, it's 32% above what it would have been if I had taken it at 66.7 years of age. Okay. So that meaning, okay, at age 67, this is what I'm going to make. 66.7, this is what I'm going to make. And I'm going to delay until I'm 70. And this is how much I'm going to make. Okay. So you get this pretty significant bump. It's an incentive. That way, keep working and delay this. Okay. Right. Again, why does government do this? Okay. They figure, by the time I'm 70, okay, yes, we're going to give you more money, but there's a good chance you're going to die. And, believe me, the economists, the statisticians look through it and they explain that. Okay. All right. So this is the example. You look at somebody who's a lower wage earner. Okay. So this is the calculated desired age of retirement at 2000. Show this person, Colleen. She's say 62 years of age. At 67, she'll make 2 grand a year. She accesses it now. You see, she gets a remarkably reduced amount coming in here. Okay, so it's cut down by almost 30% here. But if she waits till 70, she gets this big bump in the benefit. So that's this kind of age incentive. Alrighty. So now we have the plans. Okay. So when you look for a job, find out about these. They're all very similar plans. Okay. A government agency has a 457 plan. Not-for-profit 403Bs, and then corporations, okay, have 401Ks, all right? And small business has kind of an equivalent called the SEPA-RA, but just to note that it's out there, okay? All righty. So there are certain components to these things, okay? When we look at that compared to an IRA, and I don't really understand why this is done with IRAs, but when you start making a certain amount of money, then the ability to invest in the IRAs, it disappears. All right? It's just part of the government plan. Okay, and we'll go over that in a second. However, I could be making 15 million a year. I can still invest into my 401ks. Now I can't invest $15 million. There are limits on what I can invest, but I can still invest in it. Okay, which is that's a big thing that we're talking about here. There are no income limits of investing. I can do this my entire life. Okay, alrighty. We're going to look at Roth IRAs, okay, as well, and IRAs, and that's outside the 401k. The reason I put this in here is for example, Roth IRA, you have to be making, as it says right here, a gross adjusted income of 150 grand or less. And at that point, then you can no longer do a Roth IRA at 150 grand. If you're married, that's the maximum amount of money you can make, and then you no longer qualify for the Roth IRA. So that's a big difference. 401k doesn't really matter. Okay, alrighty, and so there's other limits that come into the IRA that we'll talk about later. So what's the benefit of 401k? All right. I'm deferring, like I said. All right, so let's say I invest 50 grand a year, okay, into my Roth IRA, okay? So That's money that's not taxed. Okay. Well, see, there's a limit how much I can put in. That 50 grand would be in the limit that considers my matching funds. Okay. So this money is not going to be taxed. Okay. So let's say I put in my limit. Okay. And find my limit down here. There it is. So I put in $23,000 a year. I subtract that from my annual income and it puts me into a lower tax bracket. All right? Awesome. Okay. And I will only be taxed on that later on because I'm older. You see, I'm up here in this range. So I can tack on an additional 11,250. Right. So I'm putting in actually in my 401k right now, I'm putting in 34,000 $34,750 annually, and then USC has a matching 2-to-1, so I hit this 70 grand easily. Okay, all righty. Anyways, all right. So that's the look at the I reduced my taxable income right now by 30 grand a year. Okay, something to think about. Pretty awesome. Okay. Okay. The company match. Okay. All right. And then because we are subtracting this money out and investing it, I'm only going to pay taxes on it when I'm 75 and I'm pulling it out, and my expenditures are lower. All right. So there's a big tax savings, especially if you look over the long term. Right. Okay. So that's these categories of company-based investments. Now, we also have individual retirement accounts that you do outside of this. Okay. And that's what it stands for, individual retirement account. Okay. So, if you're working and in addition to this and you're earning income, you can also set up your IRA or Roth IRA. It all depends on how much money you're making. Like I said, there's a limit that we saw with the Roth IRA and versus IRA. Why don't I want to do a Roth IRA? The cool thing about Roth IRAs is right now when you're making 30 grand a year, 40 grand a year, you invest that money. It's your after tax money. So you get your paycheck, the federal income tax is taken out, and you put it into this Roth IRA. You're making such poor income right now. Your tax rate is tiny, okay, compared to what it's going to be when you're much older, okay, because you're going to be super successful. So your paycheck maybe is taxed at, say, 7%, whatever it is. I'm throwing it out there. Okay. Then, so that's fine. All right. And then you take money and put it in that Roth IRA, it grows. And when you access it, say at 62, 65, you don't pay any taxes on that at all. All right. So that's huge. And that's why doing a Roth IRA is really important right now. Okay. IRAs, those are like 401ks. Okay. So you take the money out. Okay. You subtract it from that year's taxable income. All right. And then you go after it later on when you're retiring. Okay. And then because you're going to be spending less when you're retiring, there's a big tax benefit. Okay. All righty. So in terms of being able to use IRAs, okay, and subtract it from your yearly income to have that tax benefit, it phases out right here in terms of the tax benefit. You can continue to invest in IRAs, but the tax benefit phases out based on this income. So I get a partial tax benefit here. So this is where you get the full tax benefit. All right, I'm making too much money, and above this, okay, I can no longer deduct that from my income. I can still put it in an IRA. I can put it into an account. I just don't get the tax benefit. Okay. They up it to joint married filing jointly. Okay, and there's other specifics right here. All right. So that's some of the limits. Okay. Again, these are the limits in terms of Roth IRA. IRA eligibility. You can check that out. Okay. All right. Whoops. Sorry. So let's get into the tax benefit background. So we have traditional IRA or Roth IRA. You guys should be doing this right here. You can make withdrawals after age 59 and a half and not suffer penalties. Again, these are supposed to be retirement accounts. So if you start taking money out early, there can be a penalty. There are certain clauses, if there are emergencies, where you can still take it out. Okay. Alrighty. So these are the limits we talked about with a 401k. Now we can compare this now to the IRA and Roth IRA. So it's far less, you see. So if you don't work for a big company, you don't get to do as much. Okay. Alrighty. So we see right here the annual limit, okay, that you can put into a Roth IRA or traditional IRA in 2025 is $7,000. If you're over the age of 50, they give you a little bump. Remember the big bump I got here over the age of 50? I had a 401k in terms of my eligibility, okay? An even bigger bump here, okay? So the individual investor gets kind of screwed on that, okay? Again, this right here is just like the separate entity we're not going to talk about, SEPA IRA, that is much more so similar to my 401ks. All righty. That's it. Okay. Why is this so important? All right. Let's look at compound interest. What does that mean? It just means when you put money in, every year it earns interest. And now that money, that interest that it made, okay, so it was a good investment. It goes back onto the core of the principal. And then, so here's your principal. You made some money this year, okay, from interest. All right. Beautiful. You leave it in there, and now the principal's larger. You make the same amount of interest. Now it's bigger. But you see, instead of going, it goes exponential. All right. So here's an example. All right. So you put 10 grand in, you look the other way with a really, really kind of poor return on the investment of 5%. Okay. We're right around 8. Okay. Some years better, some years not so much, okay? And but if you're making just 5% every year, after 30 years, that 10 grand is now worth 40 grand. You didn't do anything, you just left it in the account. So that's beautiful, okay? Some people get crazy and skittish during the highs and lows of the stock market. This, the last 6 months, okay, with the change in the presidency and the economics, okay, it's been seesawing, okay. You can't. I've watched so many videos, read books from the CEOs of all these investing corporations, and they said you can never predict stock market swings. Okay, only if you're an insider trader. That's a whole different story. So the best thing is the thing is to just leave it alone and watch over the long haul. I looked like a genius in 2008. I knew people that were just pulling money out in a panic. I left it in there. And so, yeah, my investments went down. But man, when it came racing back, I was so well positioned and it all worked out. Okay. That's called dollar cost averaging. Okay. On average, between the peaks and the valleys, you're going to do better. So just leave it in there. Okay. Okay. And here's a really cool article about looking at that, the good times and the bad times by Investopedia. All right. Okay. So this is compounding. Okay. This is how much money you put in. Okay. 30 years. This is what happens. So that's, I showed you, shows the number above. This is not linear. Okay. This is exponential. And that's the beautiful thing about leaving your money and investing it. All right. Now, there are other things. All right. These are other options. How about a pension? Julia has a small pension from the big company, the Automobile Club of Southern California. They offered a small pension, okay? But, for the last, she tapped into it about 7 years ago, like I said. So it's just, it's almost $600 a month that she's getting, okay? And there's a way of looking at it, okay? And choosing to have a reduced stream, but if she dies, I will continue to get that $600 a month, okay? When I die, my kids, that's it. You don't get it, okay? And that's the thing about pensions, okay? Alrighty. But we have the traditional pensions, we think about police officers, members of Congress and the Senate, the president, firefighters, city workers, public school teachers, etc. They have pensions, okay? This guaranteed income. Now, whether you're a government worker, you're a school teacher, the money that you put into the pension system, it gets invested, okay? It gets in. Teachers have a mandatory amount to put in. In the other ones, there's not a mandatory removal of the paycheck. It's just all part of our tax dollars, okay? That guarantees the pension for these guys, okay? Um, okay, so here's the company. The company contributes funds, okay? Or let's say the government contributes funds, okay? They invest, okay? They hope for a good return, like we showed here above. All right, they hope for this nice, beautiful return on the investment, like that, okay? And then the pensions come out as payments to all the retired employees, okay? All righty. So it could be the government, it could be the company. Okay, the last thing we're going to talk about here are what are called annuities. And annuity is where you give your money, okay, to an insurance company. And then they guarantee a certain return on your investment. And they guarantee you that you will have um, a steady income level every month, okay? People do this because they're afraid of like what happened in 2008, okay, where they lost all their investments. So this is a way of maintaining the flow. Now, the problem with this is that, like I said, you're only going to get a small return. The insurance company is going to make money on the amount of their investing that doesn't go back into your account, okay? Yeah, there are really high fees, okay? 1%, 2% that happens, and you have to be very careful about inheritance or beneficiary issues. So if you invest in an annuity, make sure if you die that your kids will inherit the principal that was in that annuity. Okay, so it's all sketchy stuff. Okay, you can read up on this right here. Again, this is a very hard pitch from financial planners, and the reason they do that is they get a chunk of money. So, you know, nothing in life is for free. It may sound beautiful and flowery, you know, it may be good for you, okay, but just realize it comes at a cost. You could take that same money that you would give to an insurance company that does the annuity, and you could put it into your very own Fidelity account, and then there's really no limitations, okay? Awesome. And sometimes, God forbid, the insurance company would fail, and then you're screwed, right? Lastly, what are you going to do here? I want to keep investing money, okay? You could do it, you know, way past when you've invested all your money in your IRA, Roth IRA, and you still want to keep investing. Some people invest half their income, okay? All right, and that's all good. And that's called a brokerage account. It's the same company. So you can have a brokerage account in Fidelity, and then you have your separate IRA, Roth IRA, 401k, all right? That's all this, you know, it's all the same. It's just different categories, okay? The difference with this is whatever gains you make during that year with your investments, it's not tax protected. Okay, the government wants a piece of the company will report your capital gains, and then the government will charge you a capital gains taxes, and that's right here. But you know, it's all good. You know, what if you made a ton of money? Who cares? You know, again, you're not going to pay on the principal. You're only going to pay on the gain. Okay, and so this shows you bump. The more money that is made, the more gain that is paid. All right, that's all that. All righty. Don't forget about fees. I keep talking about that. All right, these are looking at active funds. This is where you have a broker, okay, and a money manager, investment counselor, somebody that works at Fidelity or Morgan Stanley, who's managing your funds. Or you just, so that's active management, or if it's just in these funds like I do, okay, I pay a small fee in Fidelity to manage my own funds by investing in index funds, okay? And so you see there's a difference here in terms of the amount of fees that are charged. These are percentages of fees across the different types of investment strategies, okay? And lastly, we can see right here, we'll see what happens, okay? If So the fees we pay are far lower than this. Okay, so we can look at um, uh, the total amount that has grown. All right, so we've blown past this. Let's say your total amount of money after 30 years that you've made. This includes the principal and the um, the gain. Okay, it's the annual gain you have. Okay, that's compounded. So let's say at the end of 30 years, it's almost 600 grand, $588,000. Okay, if there was no fees, then that's how much you get. Okay, but you see, you start tacking on fees, you can subtract that out. Okay, so if you have somebody that's charging 2%, okay, in fees versus me, okay, almost 200 grand ahead of that person. That's why you have to be aware of fees. All right, all right. Very long-winded, but this is an important lecture, and you really need to be able to keep an eye on your money and know what's going on. Even if you have a money manager, you should be able to go in and look at it and understand what's going on. Okay? All right, guys. Peace, and we'll see you next time.